Chapter 10, Depreciation, Cost Recovery, Amortization, and Depletion. So when we talk about depreciation for tax purposes, obviously if you're this point in your accounting education career, you should have a basic handle on financial accounting, depreciation methods, and the purpose and all of that has to do with depreciation. And so obviously when we look at it from a tax standpoint, we want to basically highlight the differences between depreciation for book purposes, or in other words, financial accounting depreciation, and the mandates from the code and provisions in their regulations dealing with depreciation and what you're allowed and mandated to do for tax purposes. So generally, you can only depreciate property used in trade or business or for production of income, so that's not all that different. Personal use assets are out. We're not going to depreciate assets with an indefinite life, and depreciation will generally start in the year the asset is placed in service. So generally, for financial accounting purposes, the only one that might be slightly different there would be when you start to depreciate an asset. But for tax purposes, you are required to start that in the year the asset is placed in service. So if you purchase an asset but don't place it into service until the following year, you need to wait until that point to start depreciation. Allowable depreciation must be used to decrease an asset's basis, even if the taxpayer does not recognize the depreciation deduction. So that's where you need to know the difference between the words allowed and allowable depreciation, where allowed references basically the actual amount of depreciation deduction taken, and allowable would be the amount that would be able to be taken but may or may not have actually been taken for the year. Bonus depreciation provisions expired as of December 31st, 2014, so those should not be as big of an issue anymore. When we look at depreciation for tax purposes, obviously there are some of these issues that will pop up. Is it tangible or intangible property? Depending on the answer there, we're going to determine how to depreciate that or whether to depreciate it at all. Real versus personal property, keeping in mind that personal property is anything that's not real property basically, and does not necessarily mean personal use property, where personal use property would be obviously the property that is not used for trade or business or the generation of income, and therefore not depreciable. And personal property would just be any property that's not considered to be real property. Then we have the issue of whether we're going to capitalize or expense the amount or part of the depreciable cost. And then the situation comes up occasionally where you have property that's converted from personal use to business use, and sometimes it even comes up going the opposite direction as well. So, based on when a piece of property was placed into service, we're going to use one of these different methods of accounting. So we've got makers, acres, and Section 167, where Section 167 basically follows the financial accounting rules. Then we have acres, which is only used for any property placed into service between 1981 and 1986. So obviously anything that fits into that category, you would just be following the same depreciation schedule that has already been set up for that piece of property, since anything in that category would have a number of years of depreciation history already attributed to it. And then anything placed into service, and these obviously are going to be the bulk of the items that we deal with today, would be following the maker's modified accelerated cost recovery system of depreciation. And so that's what we're going to focus the most attention on. Under makers, we don't consider salvage value when we compute depreciation, so that would obviously be one of the big differences between tax and financial depreciation for those assets. And under makers, there's basically a bunch of different asset classes, and you will categorize assets into the various classes, and the classes have certain time periods associated with them, under which those time periods will determine the amount of time that you're able to, or that you are required to use in depreciating that asset. Under the makers system, we also use conventions, and these are basically assumptions made as to when assets are placed in service. These are, again, another type of accounting fiction, basically. So under conventions, these are basically mandates of what date you would use as your date of placing in service. So basically, we have more or less, these are the three conventions that we have. We've got a half-year convention, mid-month convention, and mid-quarter convention. Okay, so the half-year convention is generally used for tangible personal property, mid-month for real property, and mid-quarter only applies in special circumstances and only applies to some categories of tangible personal property. So under the half-year convention, you basically, no matter what the actual date that it goes into service is, if it falls in this year, you would assume that it has a date of service date of the midpoint of the year. So basically, the first year that it's placed into service, you will be able to recognize 50% of 1 year's worth of depreciation on that asset. Mid-month would be similar. Whatever month it is placed into service, doesn't matter the date, but you will use the 15th of that month as the official date that it's placed into service. Okay. There are some exceptions to that rule where if you have a certain percentage of the assets that you placed into service in the year, basically kind of if you're backloading the year where a very high percentage of the assets that you place into service for the year occur during the last several months of the year, then there are provisions for not using the half-year convention. So, but you're not going to get away with anything by saying, oh, well, let's place all of these assets into service in December, and that way we'll get to recognize many more months of depreciation than actually happen. So keep in mind that that's an issue. I'm not gonna go over in this lecture the specific percentages and how you are going to alternatively calculate that, but those are all set out in the book, and we'll briefly look at some of those conventions. So these are the basic steps that you're going to use in calculating depreciation for personal property. Again, this is not personal use property. This is other than real property. So you'll start with determining the cost. You will select the method of depreciation. Default is a 200% double declining balance. You can also select 150% or straight line. It's useful to remember that usually if you have a choice in the matter, the convention tells you one way, and you can select a way that would increase the time frame that you would recognize this depreciation over. There's really usually not an option that goes from the default to a method that increases the speed. For the most part, if you're able to elect a different method other than the conventional method, it usually allows you to elect a slower time period to depreciate over. You're going to determine the recovery period, and this is going to be based on the table and the category that you select. You're going to select the convention, in which in usual, the default again is going to be the half-year convention, but you may have the mid-quarter convention in certain circumstances, and that's, like we said, usually when you have a certain percentage of assets that come into play towards the end of the year. then your final step, of course, is going to be to take the rate, whether it be the 200% double declining balance or the 150 or the straight line, and we're going to multiply that rate times the cost, and that will give you the amount for the year. And those are all set out in tables in the revenue procedures. Selecting the proper convention, this little flow chart that can help with that. So you can take a look at that. And notice that here in the bottom right corner is where we talk about if a certain percentage is placed into service at a certain period in the year. Under Section 179, you were allowed to expense up to $25,000 in 2015. It was significantly higher in recent previous years, but you are able to make the election to immediately deduct up to that amount of personal business tangible property. Because of the designation there, you're not allowed to use that for real estate. You will select this year to year and designate which assets will be affected by it. Any assets that are not affected by it and not elected will be subject to makers, conventions, and numbers. The limitations that are there under the Section 179 election are as follows. Has to be used in an active trade or business and for more than 50% of the use. Rental activities generally not eligible. Property can't be acquired by gift, inheritance, or from a related party, so basically generally has to be purchased. And the Section 179 deduction needs to be greater than what it would have been allowed as depreciation if, or what would have been allowed as depreciation is recaptured if the property converts to personal use. So if the property converts to personal use, depreciation would be recaptured, and the amount of the deduction has to be greater than the amount that would be recaptured under that format. Okay, I know that's a little bit confusing. Next, under the current year's amount of $25,000 max, you start to phase out the qualified property that's placed in service when it exceeds $200,000 in 2015, and it's a dollar for dollar phase out. So each dollar that exceeds $200,000 will reduce the maximum amount allowable of $25,000 until you reach $225,000 when it's completely phased out. Finally, the 179 deduction cannot exceed the taxpayer's taxable income before calculating the 179 deduction. Any suspended acquisition costs are allowed to be carried over to the next year. Moving on to real property. Generally, real property is divided into two categories, at least real property that is able to be depreciated. Those two categories are residential rental property, and that is given over a period of 27.5 years under makers, and non-residential real property, which is basically anything that is not considered residential rental property, is a 39-year time period. For residential rental property, the rental income has to be greater than 80% of gross rental income and includes rent from houses, apartments, and manufactured homes, but not hotels, motels, or similar properties. Under these provisions, there's a mid-month convention, and the straight line depreciation method is used with those time periods applicable. So here's a little flow chart in calculating real property depreciation. Start with determining cost. Assume salvage value is 0 again. There's only a straight line option available. Really, you're only selecting between the time period of 27.5 years for residential rental property and 39 years for everything else. Under either circumstance, you're going to use the mid-month convention, and then, of course, you would multiply the rate times the cost. I also want to take a look at qualified leasehold improvement property. This would be improvements to items that are leased out. They must be made by lessee or lessor pursuant to a lease. It must be placed in service more than 3 years after building is placed in service. So it can't be, more or less, it's trying to prevent recognizing a qualified leasehold improvement that should have been just part of the original cost of the building. And enlarging a building, installing elevators, escalator, or anything that affects the internal structure of the framework is not considered a qualified leasehold improvement. Okay, so these would be those that are not considered that are still capital improvements would just then revert back to either being under the 27.5 or 39-year time period, and that would not be applied to whatever's left of that period for the building. It would be a new 27.5 or new 39-year time period. Provisions permitting bonus depreciation and 15-year treatment ended, like we said, on end of 2013. And from then on, normal non-residential real property depreciation rules apply. So really not all that important to recognize the distinction there. So the alternative depreciation system is basically the longest cost recovery system available. It uses straight line depreciation and either the mid-month, half-year, or mid-quarter convention. Convention selection is made the same way that it would be under the regular Makers system. Makers requires tangible property used outside of U.S. to be depreciated under this ADS system. And the taxpayer has the option, again, of electing ADS for other property, both real and personal. Again, this follows the provision that, in general, if you're given an option, usually that means that the option would extend the time period that it takes for you to recover the cost of the depreciable asset. For personal property, ADS applies to the whole class. So depending on what class it's in, it would apply to anything that's in the 5-year property class or the 7-year class or whatever. When you're talking about real property, you can kind of use ADS on an ad hoc basis, so you wouldn't have to make a selection for everything within the 27.5-year class or the 39-year class. You can pick individual properties and use ADS on those. Obviously, it's going to be a tax planning issue of deciding to use ADS instead of one of the other methods. And usually, and this is the case with any time you would want to elect to have a costs recognized over a longer period of time rather than, the usual theory is the time value of money would suggest that you want to use deductions and anything that you can to take advantage of money now versus money later, because money now is generally considered to be worth more than money later based on the time value of money. The only time that that's not true, for tax purposes anyway, is generally if you have some net operating loss carryover. So in other words, based on your net operating loss for the year, you're not going to even be able to use all of that as it stands. So there's no incentive for you to increase the amount of deductions that you would have for this year. Or again, similarly, if you are subject to the alternative minimum tax, you wouldn't want, and we obviously haven't talked too much about that yet, but basically you would not want to add anything else to your tax deductions for the year if you're already having to calculate tax owed under the AMT system. Listed property. Makers depreciation is limited for listed property, which consists of items that could easily be used for business or personal use. So the name Makers suggests that in general, this depreciation system is going to allow you to to recognize accelerated cost recovery or accelerated depreciation, and we want to limit the amount of excess depreciation you would be able to recognize if it's an item that is ripe for abusing and basically lying about business versus personal use of that asset. So we're going to take away that temptation by limiting the amount of accelerated depreciation that you can use on items that are ripe for abuse. These are subject to depreciation recapture if business use falls below 50% in later years. So basically, if either by choice or through audit it's determined that the business use is less than 50%, you are subject to having to recapture depreciation already recognized, basically the bonus depreciation already recognized on these assets as taxable income in the year that this recapture takes effect. So this is kind of a disincentive for people to lie about business versus personal use, get caught in an audit, and then have to recapture that amount. This is a tool for the IRS to be able to go in and audit someone and be able to force them to recapture depreciation that was accelerated and already used in prior years without forcing them to go back and recalculate and do an amended return for those years. Okay, so that's just a little chart of what's available when you have greater than 50% or less than 50% business use when the property is listed property. And again, listed property is just property the IRS believes to be ripe for abuse in determining or claiming that it's business versus personal use. One category of that listed property is luxury autos, and there are some special rules related to those. I won't spend a lot of time on them, but there's a few slides devoted to dealing with luxury autos. In general, trucks and SUVs are not subject to luxury auto limitations, even though cost-wise, they're significantly more expensive usually than their similarly classed automobile counterparts. So since they're generally not limited or by these luxury auto limitations, they are generally able to take Section 179 depreciations without limitations. However, to be considered a truck or an SUV under these provisions and these exceptions, it has to be built on a truck chassis and weigh over 6,000 pounds. So it doesn't really matter what the manufacturer of the automobile classifies the vehicle as in terms of is it listed as an SUV or a truck. The IRS classifies an SUV or a truck as something that's built on a truck chassis. So this would be, for instance, I believe something like a Honda Pilot, which we would generally consider an SUV, I think is built on a vehicle or a non-truck chassis. And I think even the Honda Ridgeline, which is considered a truck and looks like more or less like a truck, I think that's actually built on a car chassis. And so if that really is the case, those would not be considered trucks and SUVs for these purposes. SUVs are limited to $100,000 of immediate expense under 179. There are some exceptions as well. Vehicle cannot be used for personal use, and the LA limits do not apply there. There are a special category of light use trucks that are less than 6,000 pounds but actually built on a truck chassis. Light or medium duty pickup trucks sometimes fall into this category. And while they're not subject to the complete exceptions for normal greater than 6,000 pound truck and SUVs, they do have higher limitations than a non-truck and SUV luxury auto. So these are various categories that we would want to take a look at for amortization of intangibles. Under Section 197, these intangibles are intangible over a 15-year straight line method. with month of acquisition. This only applies, 197 only applies to intangibles that are acquired, not developed within the company. So it can't be something developed within research development of your company. It has to be something that you went out and purchased. For designation purposes of what type of property this is, it's treated as 1231 property that has been held for greater than a year, but also subject to 1245 recapture rules. 197 property is also no loss is recognized on the sale of one intangible if some or all of other intangibles acquired at the same time are still being held. So if you acquire a bunch of 197 intangibles at the same time and sell off a piece of that, you're not able to recognize a loss unless all of it is sold. Instead, basically, you would just convert whatever the basis of the sold property was to being part of the basis of, you would convert the portion of the basis of the sold property that would be normally recognized as a loss. You would convert that over to the overall bases of the remaining assets that you acquired at the same time, and so they basically, the bases of all of those properties would be increased by that disallowed loss on a pro rata basis. So these are some examples of intangibles that would be considered 197 intangibles: goodwill and going concern, customer list, suppliers, information base, licenses or permits granted by the government, covenants not to compete, franchises, trademarks, and trade names. So the next category we have are 174 intangibles. These are research and experimental expenditures. So these are intangibles that you are, or expenditures that you're using to develop intangibles in-house. This includes experimental and lab costs incidental to development of a product. There are various tax treatments that are possible for these type of expenditures. It's possible to expense them in the year paid. You can capitalize and amortize over 60 months, or you can capitalize and write off, but only able to do that when the project is abandoned or becomes worthless. Under computer software, this is treated differently than other types of intangible property, intangible depreciable property, and it's also different based on whether it's developed in-house, purchased, or leased/licensed software. And you have the various rules in front of you here on this slide. I won't get into that too much. Similarly, for depletion, intangible drilling and development costs, this is a very niche area, so I don't like to spend a lot of time on it. Obviously, if you're going into oil and gas, either oil and gas law, oil and gas business, doing finances for an oil and gas company, then this is an area that you would want to take more of a look at. But since it's a very small component of what you might see in a normal tax practice, I'm not going to spend a lot of time on it. Your book goes into it a little bit more in detail, and so if you have specific questions there, you can take a look through that. Similarly, I will not test specifically on depletion, intangible drilling, and development costs. For tax planning considerations, some of the areas that you might want to look at, and I would say are listed here. I would say the biggest tax planning consideration that a tax consultant would look at, or the most common one, would be that ADS instead of makers in the case of having a net operating loss for the period, or being subject to having to use alternative minimum tax for that year's taxes. Form 4562 is the one that's commonly used for depreciation, depletion, and amortization, and then the effects of that form are carried over to other forms based on what type of business or individual that you are. So there's a look at what 4562 looks like, page 1, page 2, and that's pretty much the main concepts from this chapter that we should be considering.